Imagine waking up to headlines hinting that one of America's biggest foreign creditors may have quietly pulled the plug, unloading tens of billions in U.S. debt and sending a shiver through banks, bond traders, and everyday savers alike. Because when the world's second largest economy makes a move like that, it's not just a transaction, it's a warning shot. And today we're unpacking what it really means if China dumps $50 billion in U.S. Treasuries and why whispers of bank panic suddenly feel uncomfortably real. To understand why this story has people on edge, we have to start with what U.S. debt actually is and why China matters so much in that picture. When the United States runs a budget deficit, meaning it spends more than it collects in taxes, it fills the gap by issuing Treasury securities. These are essentially IOUs sold to investors, promising repayment with interest over time. Treasuries come in different flavors: short-term bills, medium-term notes, and long-term bonds, but all share one core reputation. They're supposed to be among the safest assets on Earth. For decades, countries with large trade surpluses, especially China, have parked their excess dollars in U.S. Treasuries. It's like a massive savings account that also helps stabilize global trade. China sells goods to the U.S., earns dollars, then recycles those dollars back into U.S. debt, keeping its own currency competitive and its reserves liquid. That's the basic bargain that has underpinned the global financial system since the late 20th century. Now picture what happens if a major holder suddenly starts selling in size. $50 billion sounds abstract, but in bond markets it's a heavy object dropped into a relatively calm pond. Prices of bonds move inversely to yields, so when large volumes hit the market, prices fall and yields rise. Higher Treasury yields ripple outward, raising borrowing costs for mortgages, car loans, credit cards, and even corporate debt. It's like turning a single valve and watching pressure increase throughout an entire plumbing system. Banks, which hold treasuries as both investments and regulatory capital, feel that pressure immediately. When bond prices fall, the value of what banks hold on their balance sheets drops too. If that decline is sudden or sharp, confidence can crack, and in finance, confidence is everything. This is why even the rumor of China dumping U.S. debt can spark talk of bank panic. We saw a preview of this dynamic in recent years when rapid interest rate hikes crushed the market value of long-dated bonds. Some banks that had loaded up on treasuries during low-rate years suddenly found themselves sitting on large, unrealized losses. On paper, those losses don't always matter if the bank can hold the bond to maturity. But markets don't run on paper alone. They run on trust. Depositors don't ask whether a bond will mature in 10 years. They ask whether their money is safe today. When fear spreads, withdrawals accelerate, and that's how stress turns into crisis. The China angle adds a geopolitical layer that makes the situation even more combustible. Beijing has been slowly reducing its treasury holdings for years, not in dramatic dumps but through gradual diversification. The reasons are practical and strategic. On the practical side, China needs liquidity to support its own financial system, especially as growth slows and domestic debt pressures rise. On the strategic side, holding too many U.S. assets exposes China to political risk. Sanctions, asset freezes, and weaponized finance have become real concerns in a world where economics and geopolitics are increasingly intertwined. Selling treasuries, even partially, can be read as a signal: we are less willing to bankroll your deficits and we want more control over our own reserves. But here's the critical nuance that often gets lost in sensational headlines. Dumping $50 billion of U.S. debt is not the same as collapsing the treasury market overnight. The U.S. bond market is enormous, measured in the tens of trillions. Daily trading volumes are massive, and there are plenty of buyers, from pension funds and insurance companies to central banks and hedge funds. However, markets are not just about size, they're about marginal flows. The last buyer sets the price. When a large, price-insensitive seller steps back or exits, yields can jump quickly, especially if others rush to front-run the move. That's where panic psychology enters. People don't wait to see the full impact, they move because they fear what others will do. This fear doesn't stay confined to bonds. Equity markets watch yields like hawks because higher rates compress valuations. Precious metals respond too, often inversely to real yields. When confidence in paper assets wobbles, gold and silver regain their ancient role as stores of value. Think of gold not as a shiny commodity, but as financial insurance, an asset with no counter. Party risk. You don't need a bank's promise or a government's guarantee for an ounce of gold to be gold. Silver, meanwhile, straddles two worlds: monetary metal and industrial input, making it sensitive both to financial stress and economic slowdowns. When talk of debt dumping and bank instability grows louder, it's no coincidence that metals markets start to stir. Historically, moments like this are rarely about a single sale or a single country. They're about underlying imbalances reaching a tipping point. The United States carries a debt load that continues to climb, while interest costs consume a growing share of the federal budget. At the same time, foreign appetite for treasuries is no longer guaranteed. Japan faces its own currency and yield challenges, Europe is dealing with fragmentation, and emerging markets are wary of dollar exposure. If China's move is interpreted not as an isolated adjustment but as part of a broader shift away from U.S. debt, then markets have to reprice risk. That repricing can be orderly or it can be chaotic depending on timing, communication, and policy response. So when people say they pulled the plug, what they're really expressing is fear that a long-standing assumption has been broken. The assumption that U.S. debt will always find eager foreign buyers at low yields, that treasuries are a risk-free anchor in a stormy world, and that banks can rely on them without question. Once those assumptions are challenged, even slightly, the system becomes more fragile. And fragility is what turns financial news into dinner table anxiety because it touches mortgages, savings, pensions, and the cost of living itself. The big question isn't just whether China sold $50 billion in treasuries, but what that sale represents in the evolving relationship between debt, trust, and power in the global financial system. Because once trust starts to wobble, the mechanics beneath the headlines matter even more than the headline number itself. And this is where we need to slow down and really look at how a move like this filters through banks, markets, and everyday life in a way that feels invisible until it suddenly isn't. When treasuries are sold in large amounts, yields rise, and higher yields don't just mean better returns for new buyers, they mean immediate losses for existing holders. Banks are among the largest holders of U.S. government debt, not because they're chasing profit, but because regulations treat treasuries as high-quality liquid assets. They're supposed to be the safest thing a bank can own, something that can be sold quickly to meet withdrawals. But safety in credit does not mean safety in price, and that distinction has become painfully clear in a world of rapidly changing interest rates. Imagine a bank that bought a 10-year treasury when yields were around 1%. That bond looked rock solid, steady income, zero default risk. Now fast forward to a world where yields are 4 or 5%. The old bond still pays the same tiny interest, making it far less attractive. Its market price falls to compensate. On the bank's books, that's an unrealized loss. As long as depositors are calm and money stays put, the bank can hold the bond and eventually get its full value back at maturity. But if depositors get nervous and start pulling cash, the bank may be forced to sell those bonds at a loss. Multiply that scenario across dozens of institutions, and you begin to see how a bond market move morphs into a banking issue. This is why even a relatively modest foreign sell-off can amplify stress. It's not just the $50 billion itself, it's the signal it sends and the timing. Markets are hypersensitive to changes in behavior from big players. If China, long seen as a steady if declining holder of U.S. debt, accelerates selling during a period of already elevated rates and fragile confidence, investors start asking uncomfortable questions. Who is the marginal buyer now? Will domestic investors absorb the supply without demanding higher yields? Will the Federal Reserve need to step in more aggressively? Each question adds a layer of uncertainty, and uncertainty is the fuel of volatility. The Federal Reserve sits at the center of this web, and its role is both stabilizing and paradoxical. On one hand, the Fed can buy treasuries, injecting liquidity and supporting prices, a process known as quantitative easing. On the other hand, persistent. Inflation pressures limit how free it can do this without undermining its credibility. If inflation is still a concern, large-scale bond buying risks reigniting price increases. This tension means markets cannot simply assume the Fed will always backstop losses instantly. That assumption worked in a low-inflation world. It's much shakier now. Layered on top of this is the global context. China's domestic economy has been grappling with slowing growth, property sector stress, and high local government debt. Selling U.S. treasuries can serve multiple purposes at once. It can provide dollar liquidity, support the yuan if capital outflows accelerate, and reduce exposure to U.S. financial leverage. But it also reduces China's buffer of easily tradable reserves. Treasuries are liquid precisely because everyone wants them. Selling them means exchanging that liquidity for something else, often other currencies, commodities, or strategic investments. That shift hints at a broader rebalancing of reserves away from the dollar-centric system. For decades, the dollar has been the backbone of global finance. Oil, commodities, trade invoices, and reserves have been priced and settled in dollars. U.S. debt has been the collateral that underpins everything from repo markets to derivatives. When a major player signals even partial disengagement, It doesn't topple the system overnight, but it does introduce hairline fractures. Other countries watch closely. If China can reduce its treasury exposure without catastrophic consequences, others may feel emboldened to do the same. That's how gradual change turns into structural change. This is where precious metals re-enter the conversation in a meaningful way. Gold has no yield, which is often cited as a disadvantage when interest rates are high. But gold's value proposition is not income, it's stability across regimes. In periods where confidence in sovereign debt wavers, gold acts as a neutral asset. Central banks have been net buyers of gold in recent years, not because they expect a quick profit, but because gold diversifies reserves away from political and currency risk. Silver, often called gold's more volatile cousin, reacts differently. It tends to amplify moves, rising faster in bull markets and falling harder in downturns. But it also benefits from industrial demand tied to energy transition technologies like solar panels and electronics. When investors sense both financial stress and long-term structural shifts, silver's dual role becomes especially interesting. For everyday viewers, all of this can feel distant and abstract, but the effects show up closer to home than many realize. Higher treasury yields feed directly into mortgage rates. A jump of even half a percentage point can mean hundreds of dollars more per month on a new home loan. Credit card interest rates, already painfully high, move up as well. Businesses facing higher borrowing costs delay expansion, slow hiring, or cut back altogether. This is how a bond market story becomes a cost of living story. And when banks feel squeezed from both sides, falling asset values and nervous depositors, they tighten lending standards, making credit harder to get precisely when people need it most. History offers sobering parallels. Financial crises rarely start with a single dramatic event. They begin with shifts in behavior that expose hidden weaknesses. In the early 1970s, the breakdown of the Bretton Woods system didn't cause immediate chaos, but it fundamentally altered currency relationships. In 2008, cracks in mortgage-backed securities went unnoticed until confidence evaporated almost overnight. In each case, assets once considered safe revealed vulnerabilities when conditions changed. The idea that treasuries are risk-free is rooted in credit risk, not market risk, and confusing the two can be costly. So when you hear talk of bank panic in the context of China selling U.S. debt, it's not about an inevitable collapse, it's about sensitivity. The system is more sensitive now. Because debt levels are higher, rates have risen faster, and geopolitical trust is lower. Small shocks can travel further and faster. That doesn't mean disaster is guaranteed, but it does mean complacency is dangerous. Understanding these dynamics empowers you to see beyond the noise and recognize why investors diversify, why central banks adjust strategies, and why conversations about hard assets resurface whenever faith in paper promises is tested, because